The next financial crash has already started, and most people won't realize it until it's too late, because this isn't a prediction. It's a timeline. It has started.
The next financial crisis is not coming as a surprise. It is not a random event, and it is not something that will suddenly appear out of nowhere. In fact, if you look closely at the data, the patterns, and the geopolitical developments unfolding, right now, you will realize something uncomfortable. The 2026 financial crisis is already in motion. This is not a prediction anymore. It is a timeline that has already begun, step by step, layer by layer. Quietly building toward a breaking point, every major financial collapse in history has followed a structure. It starts with excessive confidence, then moves into followed by external shocks, and finally ends in panic. This exact same structure was visible before the 2008 financial crisis, and even earlier during the dot-com bubble. At the time, most people believed the system was stable. Markets were rising, credit was easy, and optimism was everywhere. But underneath that optimism, the foundation was already cracking. What we are seeing today is not different. It is the same cycle, repeating itself with even higher stakes. The first phase of this timeline is already visible. Global debt has reached historic levels. Governments, corporations, and individuals are all more leveraged than ever before. Debt itself is not the problem unsustainable. Debt is when interest rates were near zero. This system functioned. But now, with central banks tightening monetary policy to control inflation, the cost of servicing that debt has increased dramatically. This creates pressure across every layer of the economy. Companies cut costs, consumers reduce spending, growth slows. And once growth slows in a debt-heavy system, cracks begin to appear very quickly. The second phase is inflation, and more importantly, persistent inflation. Inflation is not just about rising prices. It is about the erosion of purchasing power and the instability it creates in economic planning. Central banks, especially the Federal Reserve, have been forced into a difficult position. They must raise interest rates to control inflation, but doing so risks triggering a recession. Lowering rates, on the other hand, fuels inflation further. This creates a policy trap where every decision carries significant downside risk. This kind of environment historically precedes major economic corrections. Now comes the third phase, the external shock, and this is where geopolitics enters. The equation, the rising tension between the United States and Iran, is not just a political issue. It is an economic trigger with global consequences. The most critical factor here is energy. A large portion of the world's oil supply flows through strategic routes like the Strait of Hormuz. Any disruption in this region immediately impacts global oil prices. When oil prices spike, everything becomes more expensive. Transportation costs increase. Manufacturing costs rise. Food prices go up. Inflation accelerates. This is known as an energy shock, and historically, energy shocks have played a key role in triggering recessions. The 1970s oil crisis is a perfect example of how energy disruptions can destabilize entire economies. Today, the global economy is even more interconnected, which means the impact would be faster and more widespread. As oil prices rise due to geopolitical instability, central banks face even more pressure. They cannot easily lower interest rates because inflation is already high. At the same time, economic growth is slowing due to higher costs. This combination, high inflation and low growth, is known as stagflation. It is one of the most difficult economic conditions to manage, and it often leads to market instability and declining asset prices. The fourth phase of the timeline is market behavior. Financial markets are forward-looking, but they are also driven. By psychology, for a long time, markets may ignore underlying risks. Investors continue buying, assuming that growth will continue. This creates asset bubbles, where prices are no longer supported by fundamentals. But once confidence begins to break, the reversal is often sudden and severe. We are already seeing early signs of this behavior. Volatility is increasing. Investors are becoming more cautious. Liquidity is tightening. These are not random fluctuations, they are signals. Signals that the system is under stress. And when multiple stress factors aligned at pressure, inflation, geopolitical risk, the probability of a major correction increases significantly. The fifth phase is the trigger point. This is the moment when everything shifts from controlled instability to uncontrolled panic. It could be a sudden spike in oil prices. It could be a major financial institution facing liquidity issues. It could be a geopolitical escalation. The exact trigger is unpredictable, but the conditions leading up to it are very clear. And those conditions are already in place. Once the trigger occurs, the final phase begins, the cascade. Markets drop rapidly. Investors rush to sell. Liquidity disappears. Credit markets freeze. Businesses struggle to operate. Unemployment rises, and what started as a series of manageable risks turns into a full-scale financial crisis. This is not a theory, it is a pattern that has repeated throughout history. The most important question is not whether a crisis will happen. The real question is who will be prepared when it does. Because in every crisis, there are two types of people: those who react emotionally and those who act strategically. The majority panic. They sell at the worst possible time. They make decisions based on fear rather than logic. And as a result, they lose wealth. But a small percentage understands the timeline. They recognize the signals early. They prepare in advance. They manage risk. They diversify their assets. They maintain liquidity. And most importantly, they remain calm when others panic. These are the individuals who not only survive financial crises, but often come out stronger on the other side. Preparation does not mean predicting the exact date of a crash. It means understanding the structure of the system and positioning yourself accordingly. It means avoiding excessive risk. It means not assuming that current trends will continue indefinitely. And it means being aware that stability in financial markets is often temporary. Right now, we are not at the beginning of the timeline. We are somewhere in the middle. The early warning signs have already appeared. The structural weaknesses are visible. The external pressures are increasing, and the system is becoming more fragile with each passing day. The idea that everything will simply return to normal is not supported by the data. Economic cycles do not work that way. They build, they peak, and they correct. What we are witnessing is not an anomaly, is part of a larger cycle that has repeated for decades. The difference this time is scale. The global economy is more interconnected than ever before. Financial systems are more complex, debt levels are higher, and geopolitical tensions are more impactful. This means that when the correction happens, it could be faster and more severe than previous crises. So when you hear the phrase financial crisis, do not think of it as a distant possibility. Think of it as a process that is already unfolding, a sequence of events that is moving forward, regardless of whether most people are paying attention or not, because the reality is simple. The 2026 financial crisis is not a prediction. It is a timeline, and timelines do not wait for anyone.